Most people assume oil prices rise only when supply physically disappears. Tankers blocked, pipelines destroyed, refineries shut down. But in reality, markets often move long before a single barrel goes missing. Prices respond not only to what has happened, but to what traders believe might happen next. And when a war begins in one of the world's most strategically important energy regions, the market starts asking a far more consequential question. Could oil reach $150 a barrel again? The modern global economy still runs on oil. Despite decades of investment in renewable energy, oil fuels transportation, agriculture, shipping, aviation, and large parts of global manufacturing. Roughly 100 million barrels move through the system every day, linking producers in the Middle East, the United States, and Russia to consumers across Europe, Asia, and emerging economies. When tension rises near these supply lines, markets react quickly because even a small disruption can ripple through an enormous system. Wars involving major energy regions rarely stay contained within national borders. Investors, governments, and central banks all begin reassessing risk simultaneously. Insurance rates for shipping increase. Traders demand higher prices for future oil contracts. Strategic reserves become political tools. What appears at first to be a military confrontation often transforms into something broader, an economic shock transmitted through energy markets. The question of $150 oil is not hypothetical. The world has seen similar moments before. In 2008, oil briefly surged to nearly $147 per barrel during a period of strong global demand and geopolitical tension. More recently, after the Russian invasion of Ukraine in 2022, prices again surged above $120. Neither event required a total supply collapse. The mere possibility of restricted flows forced markets to price in risk. To understand why conflict can drive prices so dramatically, it helps to understand how oil markets actually work. Most oil is traded not in physical barrels, but through futures contracts. Agreements to buy or sell oil at a future date. These contracts allow airlines, shipping companies, and governments to hedge against price changes, but they also mean prices reflect expectations about the future. If traders believe supply could tighten months from now, prices can jump immediately. One of the most important factors markets watch during geopolitical conflict is the stability of transportation routes. The Strait of Hormuz, for example, is a narrow waterway connecting the Persian Gulf to global markets. Roughly a fifth of the world's oil passes through it each day. Even the perception that this choke point could be threatened sends signals through energy markets worldwide. A choke point is exactly what it sounds like, a narrow route through which a large volume of trade must pass. When something disrupts that route, supply cannot easily reroute elsewhere. The Suez Canal, the Strait of Malacca, and pipelines crossing Eastern Europe all function in similar ways. In energy markets, geography often matters as much as production itself, but supply risk is only one side of the equation. The other is political response. When conflicts escalate, governments frequently impose sanctions, economic penalties designed to pressure rival states without direct military confrontation. Sanctions might restrict banking access, block exports, or freeze financial assets. In oil markets, sanctions can remove millions of barrels per day from global supply almost overnight. This is exactly what happened after Western nations sanctioned Russian energy exports in response to the Ukraine war. Although Russian oil did not disappear entirely, trade routes were reshaped. Europe reduced imports, while countries like India and China increased purchases at discounted prices. Tankers traveled longer distances. Shipping costs rose. The global market adjusted, but not without volatility. Markets also pay attention to how producers themselves react. Organizations like OPEC, the Organization of the Petroleum Exporting Countries, coordinate production levels among major oil exporters. By increasing or cutting output, these countries influence global supply. During periods of instability, OPEC decisions become even more consequential because spare capacity, the ability to quickly produce more oil, is limited. If a major disruption removes supply from the market, producers with spare capacity may increase output to stabilize prices. But that spare capacity is not infinite. Saudi Arabia and a few Gulf states hold much of the world's emergency production capability. If markets begin to believe that buffer is shrinking, price expectations can escalate rapidly. Another structural factor often overlooked is investment. Oil production requires long-term capital spending, drilling wells, building pipelines, expanding refineries. After years of volatile prices and pressure from investors to focus on renewable energy, global investment in new oil projects slowed during the late 2000s. This created a tighter supply environment entering the 2020s. When supply growth slows while demand remains steady, the system becomes more fragile. Even minor disruptions can trigger large price swings because there is less cushion in the market. Think of it like a highway already running near capacity. One accident can suddenly create miles of traffic. Energy markets are also deeply intertwined with financial systems. Oil is priced globally in US dollars. This means changes in oil prices affect currencies. trade balances, and government budgets. When oil prices surge, energy importing countries must spend more dollars to secure fuel. Their currencies may weaken, inflation can rise, and central banks often face difficult policy choices. Inflation is the broad rise in prices across an economy. Energy plays a critical role because oil affects transportation, electricity generation, and fertilizer production. When fuel becomes more expensive, those costs eventually reach consumers through higher food prices, shipping costs, and airline tickets. Central banks often respond to inflation through monetary tightening, which means raising interest rates to slow spending. But higher interest rates also increase borrowing costs for governments and businesses. In heavily indebted economies, that creates another layer of financial pressure. This is why geopolitical energy shocks rarely remain confined to energy markets alone. They spill into financial markets, government policy, and everyday life. Stock markets become volatile. Gold prices sometimes rise as investors seek safe assets. Emerging economies that rely heavily on imported fuel can face severe economic stress. For oil-producing nations, however, the dynamic can look very different. Higher prices translate directly into larger government revenues. Countries like Saudi Arabia, Russia, and several Gulf states rely heavily on oil exports to fund national budgets. When prices climb, their fiscal position strengthens, giving them more geopolitical leverage. This imbalance between producers and consumers often shapes diplomatic responses to conflict. Energy importing countries push for stability and increased production, while exporters may benefit from higher prices. The resulting negotiations happen quietly through diplomatic channels, OPEC meetings, and international forums. Shipping routes also become strategic assets during these periods. If insurance costs for tankers rise due to security risks, shipping companies demand higher fees. A single attack on energy infrastructure, or even the threat of one, can trigger global reassessments of risk. Yet despite the dramatic headlines that often accompany energy crises, markets are also remarkably adaptive. Oil traders constantly search for alternative routes, substitute suppliers, and logistical workarounds. New pipelines are proposed, shipping patterns shift, and refineries adjust their input blends. This adaptability explains why even severe geopolitical shocks do not always produce long-term shortages. Instead, they create periods of intense volatility while the system reorganizes itself. Prices spike, incentives change, and eventually new supply patterns emerge. The real question behind the $150 scenario is not simply whether supply might fall, it is whether enough uncertainty enters the system simultaneously. Disrupted shipping routes, sanctions on major producers, reduced spare capacity, and strong demand can combine into a powerful feedback loop. In such conditions, markets begin pricing not just current shortages, but worst-case scenarios. Futures contracts rise sharply, governments release strategic reserves, investors rotate into commodities and inflation-protected assets. What began as a regional conflict suddenly becomes a global economic story. But history also shows that extreme prices rarely last forever. High oil prices encourage conservation, technological innovation, and new production. Shale drilling in the United States expanded rapidly after the price surge of the early 2010s. Energy transitions accelerate when costs force economies to adapt. The deeper lesson is that modern power rarely operates through a single battlefield. It flows through energy systems, financial markets, and trade networks that span the planet. A tanker route, a central bank decision, and a military confrontation can all influence the same price chart. Understanding this interconnected system helps explain why wars in energy-producing regions command such global attention. The question is never just about territory or politics. It is about the infrastructure that powers the global economy. If this helped you see the bigger picture, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin, Power of Wealth for more documentaries on oil, power, and the forces shaping global finance. Because in today's world, the most important battles are rarely fought only with weapons. They are fought through the systems that move energy, money, and influence across the planet.